I want you to picture a very specific, very stressful physical sensation. Imagine you are standing on the edge of a cliff. It is high, the wind is howling, and looking down makes your stomach turn. Now look across the chasm. About 50 feet away, there is another cliff.
And on that other side is everything you have been working toward.
Exactly. It's the keys to your new dream house. Or maybe it's the signed contract for a massive business acquisition you spent, what, 6 months negotiating?
Right.
Or it's the IPO for the company you built from your garage. It is right there. You can see it.
But there is a problem. The permanent steel bridge, the one the big banks are supposed to build, with the safety rails and the concrete foundations, it isn't finished yet. The construction crew is delayed.
Or the paperwork is stuck in a basement somewhere. The underwriter's on vacation. Classic.
Something like that. And here's the kicker. You have to get to the other side today. Not next month. Today. If you don't cross that gap before the sun goes down, the deal on the other cliff just vanishes.
It dissolves.
Poof. That is the nightmare scenario. You are asset rich, you have a bright future, but you are liquidity poor at the exact moment it matters most. You have a timing mismatch.
So what do? You don't wait for the steel bridge. You build something temporary, something fast. It might cost you a fortune, it might feel a little rickety, and it might terrify your accountant, but it gets you across the gap.
And that's it. That's the perfect analogy.
Welcome to the high-stakes, adrenaline-fueled world of the bridge loan.
It is a fitting analogy. Today, we are conducting a deep dive into a financial instrument that is entirely about traversing that gap. It sounds technical, bridge loan, but as we're going to see, it is a dramatic tool used by everyone from suburban homeowners to massive multinational corporations.
And our mission today is to really decode this. We aren't just going to define what a loan is. I mean, that would be wasted everyone's time. We are going to explore the mechanics of speed. We're going to look at how speed costs money, how risk is calculated, and why this specific type of financing absolutely exploded in popularity, particularly in places like the UK after the 2008 recession.
Yeah, and we have a really interesting stack of sources for this deep dive. We're pulling from, standard financial definitions, a bunch of real estate usage cases, corporate finance strategies, and we even have some specific regional regulations from the United Kingdom and South Africa to give us a truly global picture of how this works.
So let's jump right in. Segment 1, defining the bridge. When we say bridge loan, are we just talking about a short-term mortgage? Or is it something more specific?
Oh, it is much more specific. Calling it a short-term mortgage is kind of like calling a dragster a fast car. It misses the violence of the thing.
Chuckles.
Oh. At its core, a bridge loan is a short-term loan. Yes. We are typically talking about a duration anywhere from, say, 2 weeks up to 3 years. But the key term here is interim financing.
Interim meaning just for the meantime. A placeholder.
Precisely. It is a stopgap. The entire goal of a bridge loan is to provide liquidity cash pending the arrangement of larger or longer-term financing. You get the bridge loan now to solve an immediate problem, knowing, and this is absolutely crucial, that you are working on a more permanent solution to pay it off later.
Okay, let's unpack the terminology for a second, because depending on where you are listening from, you might know this by a different name. And finance, it loves to have 5 names for the same thing just to keep us confused.
That's so true. That's right. If you are in the United Kingdom, you will almost exclusively hear it called a bridging loan. It's a subtle difference, bridge versus bridging, but it marks the territory.
Right, bridging, like it's an active process.
Exactly. And if you are in South Africa, the common term is bridging finance.
Bridging finance, okay.
But if you dig into the financial dictionaries or talk to some of the old school bankers, you might also hear terms like caveat loan, or even a swing loan.
Swing loan. That sounds like something that happens at a dance party, not a bank. Or maybe a playground? I'm picturing a kid on a swing set.
It does have a certain rhythm to it. The idea is that you are swinging from one financial position to another, like Tarzan swinging from one vine to the next. You have to let go of the first vine to catch the second one. The swing loan is the momentum that carries you across that gap.
I like that.
But regardless of the name, caveat, swing, bridge, the mechanism is always the same. It is a temporary fix. And central to this mechanism is a concept called the takeout.
The takeout. And we're not talking about ordering pizza or Chinese food.
Though that would be nice right now. In this context, the takeout refers to the exit strategy. And honestly, this is the single most important part of the deal.
The exit strategy.
Yes. The money from the new permanent financing is used to take out or pay back the bridge loan.
So you don't get a bridge loan unless you already know how you're going to kill it. You need a plan to demolish the bridge after you've crossed it.
Exactly. A lender will not even talk to you without a credible takeout plan. You never live on the bridge, you cross it. If you build a bridge to nowhere, you just fall off the end. A lender will not give you a bridge loan unless you can prove you have a takeout strategy.
So here is the question I think a lot of people might have. If you have a plan for permanent financing, say a 30-year mortgage or a big corporate bond issuance, why wouldn't you just get that first? Why bother with the bridge at all? Why pay for the temporary bridge if the steel one is coming?
It comes down to the gap we talked about at the start. There is often a timing mismatch, a huge one.
The permanent financing is just too slow.
Way too slow. You need the cash now, this afternoon, this week. But the long-term approval process for a massive bank loan involves committees, underwriters, appraisals, and just, bureaucracy that can take months.
So the bridge loan buys you time.
It buys you time. But, and this is where we move into our second segment, that time comes at a steep, steep price.
Right. Let's talk about the price of speed, because my understanding is that these aren't just a little bit more expensive. These are expensive with a capital E.
They are. Bridge loans are typically much, much more expensive than conventional financing, and that is purely a function of risk versus reward.
Walk me through the math here, because I think people hear high interest and they think, oh, maybe it's 1% higher. But we're talking about something different, aren't we? A whole other level.
We are. It's a different stratosphere. Think about it from the lender's perspective for a second. They are giving you money quickly, often with less documentation than a standard bank would ever require.
Less paperwork, less time.
Right. That implies a higher risk. To compensate the lender for taking on that additional risk, they charge a premium, a big one.
So what does that bill look like? Let's say I need to borrow $1 million. Give me the sticker shock.
Okay, let's break down $1 million bridge loan. First, you have the interest rate. In a normal market, maybe a mortgage is, 5% or 6% right now?
Something like that, yeah.
A bridge loan, you're starting at maybe 10%, 12%, sometimes much higher depending on the asset and the risk.
So the interest payments are double right off the bat.
At least, but that's not the killer. The killer is the points.
Points. I always hear this term, paying points. It sounds like a video game score, like you're earning something.
I wish. It's the opposite. Points are upfront fees based on a percentage of the loan amount. 1 point equals 1% of the loan. For a typical bridge loan term of, say, up to 12 months, you might be charged anywhere from 2 to 4 points.
So a $1 million loan, if they charge me 3 points.
That is $30,000.
Wow.
Cash. Upfront. Just to open the door before you've even paid a dime in interest.
Ouch. That stings.
It gets worse because remember, this is a short-term loan.
Yeah.
If you pay $30,000 in fees for a 30-year loan, that cost is spread out over decades. It's almost negligible on a monthly basis.
But if you pay that $30,000 for a loan, you only plan to keep for 6 months.
Oh, I see where you're going. The annualized cost must be insane.
Exactly. You have to annualize it to see the true cost. If you pay a 3% fee for a 6-month loan, that fee effectively acts like an additional 6% annual interest. So now your 12% interest loan is actually costing you 18% or 20% on an annualized basis when you factor it all in. That is credit card territory. That is shark territory.
It is aggressive capital. And we haven't even mentioned the other fees, legal fees, valuation fees, administration fees, exit fees sometimes. And because the loan is short-term, those costs are amortized over a much shorter period. They hit your bottom line immediately and hard.
I also saw the term sweeteners in our notes. Now that sounds pleasant, but given what you just told me about points, I have a feeling it's very expensive.
It is pleasant for the lender, not necessarily for the borrower. In some corporate or high-stakes bridge loans, specifically in the venture capital world, the lender might demand equity participation.
Ah, so they want a slice of the pie. They want a piece of the business.
Correct. To make the deal happen, especially if it's a risky corporate venture, the lender might say, look, I'll lend you the money to make payroll this month, but I want warrants to buy 2% of the company at a discount. That is the sweetener. They get both the interest on the loan and potential upside from the company's growth.
It seems like the lenders hold all the cards here. What about collateral? I mean, they're not just lending on your good looks, right?
Definitely not. They protect themselves very, very aggressively. Lenders often require something called cross-collateralization. It means using more than one property or asset to secure the loan. Let's say you're a developer. You want to buy a new site. The lender might say, okay, we'll fund the new site, but we also want a lien on that finished apartment building you own down the street.
So if you default, they don't just take the new property you're buying. they can come after the old one too.
Exactly. They weave a web around your assets to minimize their risk. Furthermore, they usually offer a lower loan-to-value ratio, or LTV.
All right, I've heard of LTV. So they won't lend you 100% of the price. They want you to have skin in the game.
A lot of skin. For commercial properties, they generally max out at about 65% of the value. For residential, you might get up to 80%, but rarely more. They want a buffer. If the market crashes tomorrow, they want to know they can sell the asset quickly and get their money back without taking a loss.
So high fees, high rates, lower loan amounts, aggressive collateral, and they might want a piece of your company. It sounds terrible. Why on earth would anyone do this?
Because of the upside we mentioned earlier, speed and certainty. Bridge loans are arranged quickly. There's relatively little documentation compared to a bank loan. When the opportunity is fleeting, when that cliff edge is crumbling, speed is worth the premium. You aren't paying for money, you're paying for time.
That transitions us perfectly to where this happens most often. Real estate. This feels like the natural habitat of the bridge loan.
It certainly is. Real estate is capital intensive, it's illiquid, meaning you can't sell a building in an hour, and it's highly time sensitive. It creates the perfect storm for bridge financing.
Let's look at some use cases. I want to get specific here to make this real for people. Let's talk about the developer. We hinted at him earlier. Let's call him Bob. What is Bob's problem?
Okay, here is Bob's problem. Bob finds a rundown warehouse in a part of town that is just starting to get cool. He knows that if he can tear it down and build luxury condos, he will make $10 million profit.
Good for Bob. Sounds like a great deal.
But he doesn't have the zoning permits yet. He doesn't have the city council approval. He goes to a traditional bank, a high street bank, and asks for a construction loan.
And the bank says?
The bank says, Bob, you have a warehouse. You don't have condos. You don't have permits. This is a speculative risk. We don't do speculation. Come back when you have the permits. The computer says no.
But Bob can't get the permits unless he owns the land, and he can't buy the land without the money. It's a classic catch-22.
Precisely. Enter the bridge lender. The bridge lender looks at the deal and says, I see the vision. I also see the risk. I will lend you the money to buy the warehouse and pay the architects to get the permits, but I'm charging you 12% plus points.
And Bob, seeing his $10 million profit, takes the deal.
Bob takes the deal. He buys the warehouse. He spends 6 months fighting with the city council, going to meetings, all that stuff. Finally, he gets the permit stamped.
And now the magic happens.
Exactly. The moment that permit is stamped, the value of the land skyrockets. It's no longer a warehouse. It's a fully entitled development site. Now Bob walks back into the traditional bank.
And now the bank is happy to see him.
Now the bank is thrilled. Oh, you have permits. This is a safe project. Of course we'll help. They give him a cheap construction loan at 5%. And the first thing Bob does is use that cheap money to pay off the expensive bridge loan.
He built his bridge, he crossed it, and now he's on the permanent road.
That's the perfect playbook.
That is a great example. It shows how the bridge loan is basically renting risk tolerance.
That's a beautiful way to put it. You are renting someone else's risk tolerance for a short period of time.
Okay, what about the regular person? The homeowner. This one stresses me out just thinking about it. The dreaded property chain.
We've all heard of this nightmare scenario, or maybe even been in it. You find your dream house, you put in an offer, the sellers accept, but your money is tied up in your current house.
And you haven't sold the old house yet. Or maybe you have a buyer, but their financing just fell through at the last minute. The chain breaks.
Exactly. The chain breaks. The seller of the new house says, I'm sorry, I can't wait for you. I have another offer, a cash offer, waiting in the wings.
Yeah.
You are about to lose the dream home.
This is emotional. This isn't just business. This is where your kids go to school. This is your life.
Right. It's incredibly stressful. A bridge loan allows the buyer to take equity out of the current home, the one that hasn't sold yet, and use it as a down payment on the new residence immediately.
So you are technically owning two houses at once for a short time.
Briefly, yes. You are bridging the gap between buying the new one and selling the old one. It removes the conditionality of subject to sale of previous home, which makes your offer on the new house much, much stronger. You become a cash buyer, essentially.
But you're paying two mortgages. Or, well, one mortgage in the bridge loan.
You are. You are paying your old mortgage plus the interest on the bridge loan. It is incredibly expensive stress relief. But if it saves the deal on your forever home, for a lot of people, it's worth it.
What about auctions? I see these shows on TV where people buy houses at auction. It moves so fast.
Auctions are all about speed. If you buy a property at a discount at an auction, the gavel falls and you have signed a legally binding contract. You often have only 14 to 28 days to complete the transaction and pay the full amount.
And a bank can't move that fast. No way.
Not a chance. A traditional buy-to-let mortgage simply won't be ready in 2 weeks. The underwriting, the appraisal, it all takes too long. A bridge loan fits that timeline perfectly. You secure the asset with the bridge, then you sort out the long-term financing at your leisure over the next few months.
And finally, the fixer-upper, the uninhabitable property. What's the story there?
This is a really technical but important point. Regular banks generally will not mortgage a ruin.
A ruin.
If a property is deemed uninhabitable, which could mean there's no working kitchen or no bathroom or there's a hole in the roof, a standard mortgage lender will walk away. They will say, "This isn't a house, it's a pile of bricks. We don't lend on piles of bricks."
So how do you buy it to fix it? Another catch-22?
Another one. You use a bridge loan. The bridge lender lends on the potential value, the after-repair value. You use their funds to buy the ruin and renovate it. You put in the kitchen, you fix the roof. Once it is livable, it becomes mortgageable.
And then you get a standard loan and pay off the bridge.
You got it. The bridge loan actually enables the renovation of the housing stock. It's a pretty cool side effect.
So on that note, I want to clear up a point of confusion. I often hear the term hard money thrown around in the same breath as bridge loan. Are they the same thing?
It is a great question, and there is a lot of overlap, but they are not synonyms. The distinction is nuanced, but think of it like this. Source versus structure.
Lay it out for us. Source versus structure.
Okay. Hard money refers to the source of the lending. Usually this is an individual, an investment pool, or a private company, not a bank. It might be a wealthy dentist looking for a better return on his cash than the stock market. Hard money lenders focus on the asset value, the hard asset, not the borrower's credit score.
Okay, so hard money is who gives you the money. A person, not a big institution.
Correct. Bridge loan, on the other hand, refers to the structure of the loan, the fact that it bridges the time gap. It's about its purpose.
So a bridge loan can be a hard money loan?
Often, yes. A bridge loan is frequently a hard money loan because, as we've said, banks are too slow to fill that role. But you could technically get a bridge loan from a bank if they had a special fast-moving department. The definition of bridge focuses on the gap aspect, while hard money focuses on the private, asset-based nature of the lender.
Got it. Structure versus source. That's a great way to think about it. Now, we've talked a lot about real estate, but the outline mentions corporate finance. This isn't just about buildings, it's about companies.
Absolutely. In the corporate world, bridge loans are a lifeline, particularly for companies in the venture capital and private equity ecosystem.
How does that work? Companies don't have foundations and roofs in the same way. What's the collateral?
They have runway. Imagine a startup. They have raised their Series A funding, maybe $5 million. They are burning cash every month to grow, hiring engineers, marketing. They are planning a huge Series B round where they hope to raise $20 million. But negotiations with the new investors are dragging on.
And the bank account is draining fast.
They are running out of runway. If they hit zero cash before the Series B closes, the company dies. It's that simple. They can't make payroll. So they need a bridge.
Who lends to them in that situation? It seems incredibly risky.
Usually they're existing investors, the people who are already on the hook. They'll inject a small amount of cash, a bridge loan, often in the form of a convertible note to carry the company so it doesn't run out of money between these major financing rounds.
And what about distressed companies? That sounds even more ominous.
This is when a company is actively struggling and looking for a buyer. They are bleeding cash every single day. A bridge loan can carry the company while they search for an acquirer. This is often called debtor-in-possession financing in a bankruptcy scenario, or just a rescue loan.
But I imagine the lenders here want some serious protection. This isn't a safe bet by any stretch.
Oh, it's incredibly risky. In this case, the lender often demands a substantial equity position, a large ownership stake in connection with the loan. It's often called vulture capital for a reason. They are circling, looking for a cheap entry point into a struggling company.
And then there's the pre-IPO bridge, the happier side of things.
This is a much happier scenario, yes. It is final debt financing to carry the company through the immediate period before an initial public offering. You know the IPO will bring in hundreds of millions, but you need to pay for the roadshow, The expensive marketing tour and the army of lawyers and bankers today, the bridge loan covers that last mile expense.
Fascinating. It's the grease in the gears of capitalism, keeps things moving when they want to stall. I want to shift gears geographically now. We have some specific data on South Africa. It seems they have a very specific and kind of unique legal use case for this.
They do, and it is fascinating because it is driven entirely by bureaucracy. In South Africa, immovable property is transferred via a system of registration in public deeds offices.
Sounds official. And slow.
It is remarkably slow. This process involves manually checking documents against historic records, sometimes going back 100 years. It causes inevitable delays. The problem is the gap. Participants need funds now, but the money from the sale only releases on the day of registration in the deeds office.
So let me get this straight. You have sold your house. The buyer has paid the money into a trust account held by a lawyer. But you can't touch it.
You can't touch it, not a single rand, until the deeds office stamps the paper. And that can take weeks, sometimes months, depending on the backlog. So you have this weird situation where you are rich on paper, but you can't afford to pay the movers.
Enter the bridging finance industry.
Exactly. A whole industry of bridging finance companies, typically not banks, stepped in to solve this specific problem. They look at the deal, they see the confirmation from the lawyer that the money is there in the trust account, and they lend you against it. It's very low risk for them.
Who is using this? Just the sellers who need cash to move.
Sellers are a big part of it, bridging their sales proceeds, but also think about the estate agents.
Oh, right. They work on commission. They don't get paid until the deal is done.
And the deal isn't done until it registers. So if the deeds office is backed up for 3 months, the agent doesn't get their commission for 3 months. So agents often bridge their commission so they can pay their own bills.
Wow, that's a whole ecosystem running on bridge finance.
It's huge. Even mortgagors bridge the proceeds of further bonds. And it is also used to settle outstanding property taxes or municipal accounts. You often can't transfer a property until the taxes are paid, but you don't have the money to pay the taxes until the property transfers.
It's a classic catch-22 solved by a bridge loan.
And the bridge loan solves it. It really is a purpose-built solution to a very specific bureaucratic bottleneck.
Now let's travel north to the United Kingdom. Our source material suggests a really interesting history here, specifically around the financial crisis in 2008.
Yeah, the UK market is a fascinating case study.
Yeah.
Short-term finance like this existed as early as the 1960s, usually through high street banks or building societies. But it was a niche market. It was a sleepy backwater of finance, really.
Until the global financial crisis hit.
The 2008 turning point changed the game completely. We need to remember what that felt like. It wasn't just that stock prices fell, it was a credit crunch. The term gets thrown around, but the meaning is important.
Explain that for us. What did a credit crunch actually feel like on the ground?
It means the plumbing of the financial system froze solid. Mainstream banks panicked. They didn't know who was solvent and who wasn't. They were terrified to lend to each other, let alone to the public. So they just stopped lending. They became incredibly reluctant to grant home loans, especially to anyone who wasn't a perfect borrower with a huge deposit and a flawless credit history.
And nature abhors a vacuum.
Precisely. The demand for money didn't go away. People still needed to move house. Developers still needed to build. But the banks were closed for business, so bridge loans filled the void. When the banks stepped back, an entire industry of alternative lenders stepped up.
Do we have numbers on this explosion? How big was it?
The stats are staggering. Gross lending in this sector doubled from about $1.8 billion in March 2011 to $2.2 billion by June 2014.
Wow. That is massive growth in just 3 years, more than doubling.
And it kept growing. It wasn't a temporary blip. By the first quarter of 2016, residential loan amounts outstanding in the UK reached $1.3 trillion.
Trillion, with a T.
Trillion. Now, that's the total mortgage market, but it shows how integral this type of faster alternative financing became to propping up the entire UK property market. It went from a niche product to a structural pillar of the housing market.
But surely that kind of explosion comes with growing pains. I mean, if you have all these new lenders rushing into a hot market, that sounds like a recipe for trouble.
It did. There was controversy. It was a bit of a Wild West for a while. In 2011, the FSA, the Financial Services Authority, which was the main regulator at the time, issued a formal warning. They warned homebuyers against using bridge loans as standard mortgage substitutes.
Because brokers We're selling them to people who didn't really need a short-term expensive loan?
Exactly. There was a real fear that mortgage brokers were misrepresenting the suitability of these loans just to get deals done and earn a commission. They were putting families into high-interest, short-term debt when they should have been in stable, long-term mortgages.
This sounds like it has echoes of the subprime crisis all over again.
It had definite echoes of it. This led to a crackdown and tighter regulation under the FCA, the Financial Conduct Authority, which replaced the FSA. They drew a very clear line in the sand.
So how does that regulation work? Is every bridge loan regulated now?
No, and this is a key distinction in the UK market. It depends on the sleep test.
The sleep test, what's that?
It's a simple question. Who sleeps in the bed? If the loan is secured by a property where the borrower or a close family member lives or will live, it is a regulated mortgage contract.
Okay, so consumer protection kicks in. The government protects the family home.
Yes. If it's regulated, the lender has to follow strict rules. They have to check affordability, ensure the borrower understands the risks, and generally treat them fairly. But if the loan is for landlords or property developers, people who won't be living there, it is generally unregulated.
That makes sense. It's a business transaction versus a personal one. If you're a professional developer, the government assumes you're a big boy and you can look after yourself.
Exactly, but there was a weird gray area that caused a lot of confusion. The 40% rule.
The 40% rule, what is that?
This was an exception for mixed-use properties. Think of a shop with a flat above it where the owner lives. The rule was that if the borrower occupies less than 40% of the property's total area, it might fall outside certain regulations. It was a way to classify these semi-commercial properties.
But Europe had something to say about that, I'm guessing.
The EU is never far away in these discussions, at least historically. The Mortgage Credit Directive, or MCD, which was an EU-wide rulebook, does not recognize usage thresholds like that. They basically said if a human lives there as their home, it's a regulated mortgage. This cast a lot of doubt on the 40% rule, creating a complex legal landscape for lenders to navigate.
It's never simple, is it? Let's move to our final segment before we wrap up. Some of the more technical loan structures. We need to talk about open versus closed bridges. This sounds a bit like open versus closed relationships.
In a way, the commitment levels are similar. This is a vital distinction for anyone considering taking one of these loans. A closed bridge loan is available for a predetermined time frame, but crucially, it requires a clear, credible repayment plan and exit strategy to be in place before you sign the loan documents.
Like having a confirmed buyer for your house who has already signed the contract and their mortgage is approved.
Exactly. You can show the lender the signed contract. Look, the money is coming on November 1st. It's guaranteed. Because the exit is clear, the risk for the lender is much lower, and the interest rate is usually better.
And an open bridge. Let me guess. No clear exit.
Exactly. An open bridge has no fixed payoff date, though there's an endpoint eventually. You simply agree to pay it back soon. There is no signed contract for the exit. You just hope to sell the property or plan to refinance.
That sounds incredibly risky for everyone involved.
It is much, much riskier for both the borrower and the creditor. What if the property doesn't sell? What if the market turns and you can't get the price you need? Consequently, the likelihood of default is higher, and the rates and fees are significantly higher to compensate for that risk.
One last technical detail I want to touch on. First versus second charge. This sounds like knights charging into battle, but I assume it's about who gets paid first if things go wrong.
Correct. It is all about the hierarchy of debt. A first charge means the lender is first in line. If the property is sold or foreclosed upon, they get paid their money back before anyone else.
So they are the safest. They're at the front of the queue.
Yes. Because they are first, their risk is lower. They are therefore willing to offer a higher loan-to-value or LTV ratio.
And second charge.
You are second in line. Think of it like a buffet. The first charge lender eats first. They take as much as they're owed. If there is any food left over, the second charge lender gets to eat.
And if the first charge lender is really hungry and eats everything,
then the second charge lender starves. If there is a default and the property sells for less than expected, the second charge lender might get zero, wiped out completely.
Sounds incredibly risky for a lender.
It is. That is why many UK lenders, especially after 2008, steered clear of second charge lending altogether. Or if they do it, they charge exorbitant rates to justify the gamble.
Wow. Okay, let's try and unpack all of this. We have covered a lot of ground. We've gone from the cliff edge in our minds to the deeds office in South Africa.
We have. We've crossed the bridge, so to speak.
We've seen how this tool serves as a financial lifeline for developers who are just waiting on a piece of paper from the city. We've seen it as a chain breaker for homeowners trying to move house without losing their minds.
And we've seen it as a survival mechanism for startups and distressed companies just try and make it to the next milestone.
The key takeaway here, it seems to me, is the trade-off. It is always about the trade-off. You pay a premium high rates, points, fees, maybe even equity in your company for the luxury of speed.
Exactly. You are buying the ability to act when traditional banks say, wait.
It's a tool for the impatient or perhaps the opportunistic.
Or the desperate. It serves both ends of that spectrum. It saves the dream deal and it rescues the sinking ship. It's a very powerful, but also very dangerous tool.
Before we go, I want to leave our listeners with a final thought. We saw how bridge lending exploded post-2008 because the big traditional banks got slow and risk-averse. It suggests a permanent shift in how we view liquidity and time.
That is an excellent point. The system changed.
So my question is this. As the gig economy grows, as business cycles get faster and faster, will the bridge become the new standard? Will we see a world where the slow-moving 30-year traditional mortgage is seen as an antique, replaced by agile short-term financing for investors who move at the speed of the internet?
It raises a profound question about the future of banking. If banks can't keep up with the speed of modern commerce, these gap mechanisms might stop being the exception and start becoming the rule. We might be moving toward a world of just-in-time financing for everything.
Something to think about the next time you see a construction crane or a for sale sign. There might be a very expensive, very fast bridge holding that whole deal together.
Thanks for listening to The Deep Dive. We'll see you on the next one.